I'm Danny Harper, Vice President of Development at Cure Alzheimer's Fund. Thank you for joining us for today's webinar, a conversation with Patricia Annino, How to Give with Purpose and Make Your Impact Last. Today's program will explore how thoughtful estate and philanthropic planning can help you amplify your impact, protect the people you love, and strengthen organizations you care about. We are honored to be joined by Patricia Annino, JD, partner at Ramon PC in Boston, a nationally recognized authority on estate planning. Patricia is the author of 4 books, including Women and Money, a practical guide to estate planning, which was featured as recommended reading in the Wall Street Journal. She has been recognized by her peers as one of the best lawyers in America for trusts and estates, named a top 50 women Massachusetts lawyer by Super Lawyers, and honored as the Boston Estate Planning Council's Estate Planner of the Year. Patricia is a fellow of the American College of Trusts and Estate Counsel and is frequently quoted in national publications such as the Wall Street Journal, Bloomberg, and MarketWatch. Before we begin, I have a few housekeeping notes. Today's program will include a 30-minute presentation followed by Q&A. The session is being recorded and we'll share the recording with you in the coming weeks. If you have questions at any time, please use the Q&A feature at the bottom of your screen, and we'll address as many as we can during the discussion. With that, let's get started. Welcome, Patricia.
Danny, thank you. And thank you very much for including me in this presentation. Alzheimer's is something that I care very deeply about. My mother died after a 10-year stint with Alzheimer's, and I know what a long and painful runway it is. She was taken care of by family members at home, by my father, who was an active pediatrician at the time, by my sister and I was there every day, every night, and several days a week for 10 years. And I saw not only the toll this took on her, but the toll it took on the entire family. And one important thing that my father repeatedly said over the 10 years to my sister and I, make sure you take care of yourself, because the toll of being a caregiver can be very significant. And that's why the first part of the presentation, we're going to talk about remembering what that flight attendant says every time you get on the plane. If the barometric pressure in this cabin changes, put that mask over your own face first. It's only when you protect yourself that you're going to be strong enough to protect others. I'm also a big fan of Cure Alzheimer's Fund. Phyllis Rappaport is a Smith grad, as am I. I got to know her pretty well through Smith, and I've gotten to know and respect the work of Rudy Tanzi. So it's an incredibly important organization to help cure this disease, which is crippling so many families in this country, psychologically, emotionally, and financially. So next slide, please. Some of the things that we're going to talk about today are the importance of coordinating financial and estate planning, understanding the transfer tax system, coordinating the transfer tax system with income tax and capital gains, retirement planning asset, what is probate, charitable giving, and we'll go in a little bit more detail. Disability or incapacity is threatening all of us. The biggest erosion to family wealth today is not taxation. It's the cost of long-term care. And disability or incapacity in Alzheimer's hits everybody, whether they're rich, whether they're poor. Hits Brooke Astor, Donald Sterling, Sumner Redstone, Lillian Bettencourt. None of us are safe from it. So understanding and figuring out how we are going to protect ourselves so that we can make the journey as important for us and those who care about us and taking care of us is critically important. If you're listening to this webinar, then I know that you are the most responsible member of your family, which means as we're talking about estate planning, you have to look at this through 2 lenses. Not only what if something happens to me, but also what happens if someone I depend upon emotionally or financially has issues. I'm the one who's going to get the call. So it behooves all of us to make sure that not only do we have individually our own affairs in order, but also that everyone else does too, because we are going to get the call for that. Every single person I've ever met, including myself, would rather be Scarlett O'Hara in Gone with the Wind Why do I have to pay attention to any of this now? There's always tomorrow. So the challenge those of us who are advisors have is just say, hey, everybody has a planning tolerance, but start now. Do something now to put the steps in place to protect you, your family, and the organizations like Cure Alzheimer's that you care about. So I'm hopeful that at the end of this webinar, you will take just one step toward making better sure that that happens. So next slide, please. Let's talk about coordinating financial and estate planning. You know, it's important to make sure that your basic documents are in place. They include a will, a trust, a healthcare proxy, a durable power of attorney. But let's talk about the lifetime documents, the healthcare proxy and the durable power of attorney first. So a healthcare proxy, and it's called different things in every state, is a document in which you name one person. Federal law says one person at a time to make your medical care decisions for you in the event you are unable to do them yourself. Make sure that you have written down the person's cell phone number on that form, because what's going to happen is they're going to get a call. They're not going to write to find out what to do about that. If you are in a Bermuda Triangle of estate planning, a second marriage, a non-traditional relationship, a domestic partner, it is really important that you put forward who you wish to make your healthcare decisions first and then second. And if you are responsible for someone else and you are going to get the call for someone else, make sure that the paperwork is in place so you have the legal authority. You know, a couple of years ago, I was giving a speech in California, and it's the first time I've seen this happen, but a man in front of me in the airplane we had a medical emergency, and the pilots came on the plane and they said, are there physicians here? Two physicians came up, and the pilot came on and said, we've made a determination that the plane cannot go to San Francisco. We're doing an emergency landing in Dallas, Texas. And I saw the man get wheeled off, and I saw him have an oxygen mask on. And I thought, you know, his family, his office, they're not going to know that he landed in a healthcare, in a hospital in Dallas, Texas. He was on his way to a business meeting in San Francisco. Do you have your healthcare proxy with you when you travel? Does it designate the people with updated phone numbers? Do you have it scanned into your computer so it could be sent to, and whoever your healthcare agent is, so it could be emailed to any hospital emergency room in the country or the world? The healthcare proxy is an important document. And all of us have parents or college-age kids. Thanksgiving is around the corner. This is a time to make sure everybody has an updated healthcare proxy and they have filled out the right phone numbers, and everybody has a copy of it. It cannot be used against you. It's your nomination of who to make your healthcare decisions if you are unable to make them yourself. The second lifetime document to think about is the durable power of attorney. That's a financial document where you can give someone the authority to handle your financial affairs. It's a lifetime document. All powers of attorney end at death. So my husband and I own our home jointly with the right of survivorship. If I die, he gets it. If he dies, I get it. But if one of us becomes disabled or incapacitated, even though we own that joint, that house is frozen. Retirement planning assets, my husband is the primary beneficiary. I die, he gets it. But if I become disabled, even though he's my husband, and even though we're in a good marriage, he can't make an emergency withdrawal, can't make an investment decision. He's not me. So what a durable power of attorney would do, and I've done, is we've given each other the legal authority to handle each other's financial affairs. That is a power that's in effect when you sign it and continues through any disability or incapacity that you might have. It's very powerful because it's in effect now. Some people will say to me, well, why don't I, nothing personal, I just trust no one. Why can't I have one that becomes effective only if I become disabled or incapacitated? I said, it is legally valid in a lot of states, but I won't draft it for two reasons. One, I come from a family of doctors. No one wants to say that someone is disabled and therefore the other person should have full authority over their financial affairs. It doesn't work. You end up in court. And the second and more important is, if you don't trust someone to have that authority while you're competent, why would you trust them when you're not? But a very powerful thing to think about in that document, and nobody pays attention to this. When you have minor children, what you do is you make sure you go away for the first time, you leave all the notes in the refrigerator. If this happens, and you've named a guardian, you've named a conservator. Well, now in a durable power of attorney, you can name who would be your guardian or conservator if protective proceedings that's proceeding to open up a guardianship or conservatorship commence. So in a situation where your competence could be tested, this allows you to nominate, and the person that you nominate mandatorily ends up being notified in a court process. And so if you are also somebody else's power of attorney and they want you to be the guardian or conservator, it's important to look at that. It's also important to coordinate and inventory all important documents. And again, if you are depending on someone, if someone else is depending on you, you need to understand what their documents are and where they are. Who are your advisors? Do you have all that in one place? And do you have theirs? Those are all things to pay attention to. Those are lifetime documents. Healthcare proxy, durable power of attorney are lifetime documents. A will is one that only becomes effective upon death, and a trust can be continuous. You establish it now, continues through any disability or incapacity, goes past your death. But some assets, like retirement planning assets while you're alive, do not go in a trust. So most people will need all of these documents to have an effective plan. It's really important to think about that. Next slide, please. So let's talk about taxes. The federal government has what's called a transfer tax system. The tax is levied when an asset transfers. It transfers for gift purposes, for estate purposes, or for generation skipping purposes. That's when the tax levies. Right now, under the big beautiful bill, that is almost $14 billion on January 1, that each person has the right to pass to whoever they want to, or combined, it's double that, just about, almost $30 billion. So in other words, to the extent that you use it during your lifetime, it cuts into that lifetime exclusion. To the extent that you don't use it during your lifetime, it's available at death. For US citizens, it doesn't matter anymore if the husband owns the assets or the wife owns the assets or one spouse owns the assets or the other one does. There's a concept called portability. So as long as you file a form at the death of the first spouse, it is the exclusions are portable between both people. That's not true about the generation skipping tax, and we're not going to get into that today. It's more complicated. In addition to those lifetime exclusions, you can now this year give $19,000 or $38,000 per married couple to as many different individuals as you want and not have it impact your lifetime exclusion. You can pay anyone's tuition or medical expenses as long as you pay it directly to the provider and give them $19,000 or $38,000 a year and not impact your exclusion. So we are quite a way away from what the prior law used to be, and for most people in this country, the biggest erosion to family wealth is no longer taxation, estate taxation. It is the cost of care. Once you hit that federal exclusion limit, the federal rate is 40% of every dollar above that. So what does this mean to an organization like Cure Alzheimer's? It means that if estate tax is no longer the driver for charitable giving, we all have to think back about why we're supporting organizations like Cure Alzheimer's, why it matters, why private philanthropy matters, and really think about, with the loss of the ability to take any deduction because there's no tax, we don't want giving to organizations like Cure Alzheimer's to go down. We want to go back and remember that we're giving it to it regardless of any tax consequence because we believe in its mission. Next slide, please. There are only two meaningful deductions. There's the marital deduction, which allows tax deferred as long as the U.S. citizen spouse till both people die, assuming the way the assets are structured right, and the charitable deduction. So when you are above the federal level, or when you have a state estate tax, the charitable and marital deduction are really important. They are the only two deductions. Next slide, please. Don't forget about the state estate tax. In Massachusetts, we only have a $2 million exclusion. And almost everybody who owns a home in Massachusetts and has a retirement plan is close to or over that. We have a really harsh estate tax here. It goes up to 16%. If you have real property in another state, or if you live in a state like California, which doesn't have an estate tax, but you have a home in the Berkshires or in Nantucket or the Vineyard, if you've got assets in more than one jurisdiction, then the state taxes that jurisdiction, taxes the assets in that jurisdiction, but they tax more than that. They tax that plus a piece of the bigger pie. So it's important to not forget about estate tax. Next slide, please. We have to think about the transfer tax system and how it coordinates with the income and capital gains tax. Right now, under the current law, if it is included in your taxable estate, even if there's no estate tax due, the capital gains tax is wiped out for most assets, not retirement planning assets, not tax deferred assets, but that house that was bought for $100,000 is now worth $1 million. That stock in Nvidia that you bought for $10,000, which is now worth $1 million, the capital gain is worth out. Now, dying should not be a tax planning strategy, but you have to understand that there's a coordination between the transfer tax and the income tax and capital gains. And sometimes making a gift can be a huge tax mistake. If you are thinking about a gift, then you want to think about how much is enough? What do I want to give? How much should my children have now? What strings do I want in the gift? How do I want to leverage the gift? Am I willing to assume the risk that if a gift is given, it's gone? Am I willing to give away the fruit in the tree? You can't just retain the income. In most cases, you've got to give the whole thing away. And technically, have I thought about gift splitting? So those are factors when you're thinking about making a gift to family that you really want to explore. Next slide, please. Let's talk about the retirement planning asset. Retirement planning assets can be subject to both estate tax and income tax. That's federal and state. A perfect asset to give to cure Alzheimer's, death time, is the retirement planning asset. Because if you name them as a designated beneficiary, then they don't pay any income taxes on, and it's deducted from your estate. If you give it to family members, it's going to end up being subject to at least income tax, unless it's a Roth, and maybe also estate tax, depending upon where you live or if you're over the federal exclusion. If you and your spouse have several different organizations that you won't care deeply about, you can name more than one of them as the beneficiary of that IRA or retirement planning asset. So you could name Cure Alzheimer's, Smith College, Museum of Fine Arts, whatever you want to. You can talk openly and honestly with Cure Alzheimer and their development team about that. This is also a really excellent tool to use if you want to give $100,000 a year and you're over the required minimum distribution age, because you're allowed to do that. Next slide, please. And Cure Alzheimer's Development Office can help you go ahead and figure out how to do that. It's not a deduction, but it doesn't count against you. It's not taxable income to you. So if you have a significant retirement planning asset, and if you want to gift lifetime and death time, that is one of the first assets to look at if you want to make a gift to Cure Alzheimer's. Next slide, please. So we talked about what is tax-free. Well, if you're in a situation where you've got an estate tax that's due, charitable deduction and marital deduction are the only two, so you really have to think about that. Next slide, please. A lot of people are also going to ask me, what is probate? In any uncontested situation, a probate only does one thing. It takes an asset that doesn't know where you go, what happened. It doesn't know where to go when you die, and it directs it. And if you have a will, the will directs it. If you don't have a will, then the state in which you're domiciled has written one for you called the laws of intestacy. So for most people in any uncontested situation, it's only a retitling process that goes through the court system. It's no longer particularly complicated. It's no longer in most states particularly expensive. And that's because most people's assets are no longer probate assets. They're either something that has a designated beneficiary, something that's owned jointly with somebody with the right of survivorship, or something that is in a trust. It is really important to understand something. The concept of whether or not there is probate has no relationship to whether or not there's an estate tax. None. The concept of probate is totally different than the concept of tax. Next slide, please. What are trusts? Trusts are contracts. They're all different kinds of trusts. There are lifetime revocable trusts where you're in control of it during your lifetime. It's like a box. You could put your assets in it. It avoids probate. It's private. It provides for continuity of asset management. It can be a platform for estate tax savings. There are lifetime irrevocable trusts, meaning you can't change them. What that does is people will do that for gifting purposes or for Medicaid purposes. And we're going to talk in a couple of minutes about it. There are split interest trusts, which are interest between individuals and charity. I was a very young associate, and my boss was on 4th of July was off, and the office got a hysterical call from a man who said, "It's important I talk to a lawyer right now. It's urgent. My wife's trust became irrevocable last night, and da-da-da better not be the trustee." So the receptionist came running into my office and said, "Will you take this call?" I said, "Sure." And I'm thinking, my wife's trust became irrevocable last night? I said, "Sir, did your wife die?" He said, "Yes, my wife died last night." All trusts become irrevocable when you die. So all revocable trusts become irrevocable. Next slide, please. As we think about what we have accomplished and what we want to do, we want to think about our legacy. And the word legacy evokes the concept of death. But honestly, we all have a legacy now. We're all being looked at. We're all being judged. People are observing what we're doing, and we're observing ourselves what we do. Legacy matters. And I like this quote from Ernest Becker, who's a Pulitzer Prize winning author. "What man really fears is not so much extinction, but extinction with insignificance. Man wants to know that his life somehow counted, if not for himself, then at least for a larger scheme of things, that it has left a trace that has meaning, its effects remain live in eternity in some way." Next slide, please. Every one of us has a legacy now, right now, not just when we die. As Peter Caraff, who was a good friend of mine, founder of the Philanthropic Initiative, he's unfortunately now deceased, noted, we all have untouched capacity that lies within each of us. It is the essence of each of us. We are the architects of our own legacy. Intentional legacy matters. If you want your legacy to be not just part of today, but over the many days of your life and beyond, it must be intentional. That is not a question for the future. It's not one for Scarlett O'Hara. It's a question for the here and now. Next slide, please. So we have to think about charitable giving as part of our estate plan. There is involuntary philanthropy. That's when you default out, your estate pays the taxes, or your estate pays the income taxes on the retirement planning asset, and the government, God knows they need it right now, selects where and how it will be distributed. Or there's voluntary philanthropy. You choose where you want your money to go. What is it? Next slide, please. Easiest for any charity like Cure Alzheimer's is to go ahead and just make an outright gift, and you get an income tax deduction for that. Next slide, please. Planned giving is transformational. Planned giving, giving a gift now that is going to come into effect at your death or partially during your lifetime. It's transformational. It's part of integrated planning. It sustains your legacy. It allows you to preserve financial security while leaving a legacy. So all of us have different gifting story, and all of us have different rhythms to gifting. And I will tell you a pathetic story about myself. So one of the charities that I feel very, very close to is Suffolk University Law School, where I went to law school. And I was head of the Alumni Association and very involved, and really the school got my heart. And I was a completely pathetic donor. Nothing, 100, nothing, 500, nothing, 1,000. Years went by. And then my aunt, who was my mentor, died. And I was sitting down with the director of development at Suffolk, and she said to me, "Have you ever thought about starting a scholarship fund in your aunt's name?" I said, "Wow, that's a really good idea." And I did. Now, there has to be an emotional connection for most people to be able to do it. But what then happened to me is I didn't think of establishing that scholarship fund as an endpoint. I thought of establishing that scholarship fund as a beginning point. So I put in the $50,000, and then every single year over the last 20 years, I give to it, either a lot or a little, depending on how my year economically is. And I've backed it up with a planned gift. So should I die before that fund hits where I want it to hit, I know that it is sustainable. And that's what I'm talking about when I say it's part of integrated planning. If you care a lot about Cure Alzheimer's and the other organizations that you are considering gifting to, then you need to think about a plan. And gifts are a beginning point. They are not an ending point. Life is a movie, hopefully with sequels, not a snapshot. Focus your energy, make your legacy intentional, and integrate the plan. Next slide, please. Planned giving or legacy giving is part of an overall gift or legacy strategy. It includes tools you use while you're alive, tools that are effective at death, or both, like the example I just did. Future gifts ensure that Cure Alzheimer's is secure and sustainable for many years to come through turbulent economic times. Next slide, please. So types of planned gifts, outright bequest, that's easy. In my will or my trust, I do something. Designation of a retirement planning benefit, life insurance contributions, gift of real estate with a reserved life estate. For a hospital near here, there was a widow who was in a second marriage who wanted to stay at home. The hospital had been very great to her. She ended up giving them the hospital, but giving her home, $4 million home to the hospital, but retaining the right to live there. Life income gifts. For a major philanthropic organization in the western part of the state, which had a lot of people who had vacation homes there, but lived in New York or Connecticut. Their family didn't want the home when they died. They gave it to the organization in their estate plan when they died. They just gave it. For a major university in the Midwest, I worked with a man who was a trustee who bought condos there while he acted as trustee. 8 years later, he's no longer a trustee. He turned around and gave the real estate to the university. So you can think about assets, especially if significant assets, are they ones that your family want? If not, maybe a really good thing to do now for making it an outright gift is to think about some kind of either retained life estate or outright gift. Donor advised funds are great, and we're going to talk about the trust in a minute. Next slide, please. Charitable gift annuity, in which you make a contribution to Cure Alzheimer's, and an annuity comes back to you for life. The development team can talk to you about that. Charitable remainder trust. Charitable remainder trust and charitable lead trust are irrevocable documents. With a charitable remainder trust, you put the asset in, and you get back a stream of income for a term of years or for life, and at your death, the remainder goes to Cure Alzheimer's or Cure Alzheimer's and other charities you pick. Charitable lead trust is the flip of that. That's for people who are basically very wealthy people who've used a lot of their exclusion. It's very, very effective. You can, the charity gets it for the beginning term, and then at the end, it goes to the donor's family, generally tax-free, typically grandchildren. Charitable remainder trust. I had a man years ago who had a Stradivarius violin, and it had been given to him because he was a violinist, and he didn't think anybody else in the family would know how to handle its sale. And he knew the gain would be huge because his basis in it was very, very low, and it was probably worth several $1,000,000. So we put it in a charitable remainder trust, had an independent trustee. It got auctioned off by Sotheby's or Christie's, I can't remember, in London, and it yielded $2 million. So what happened then is the trust didn't pay any capital gains tax, and he got a very significant stream of income for the duration of his lifetime. But of course, the issue was his family wasn't going to be able to get the benefit of, say, $1 million or million, whatever it would have been after capital gain. So he coupled that strategy with an irrevocable life insurance trust, and he used part of the cash that he was getting to buy a life insurance policy in an irrevocable trust to replace the wealth that his family was not going to get because of the CRT. So the other thing to think about is not to use any one technique in isolation, but to look at them in tandem. I have another client who used the charitable remainder trust right before his asphalt plant got sold. He put a significant asphalt plant into a charitable remainder trust. The trustee sold it, was a major bank. It did terminate subchapter S election status, but he didn't care because it was getting sold anyway. He didn't pay any capital gains tax on the transaction, and he got a huge cash payout annually for the rest of his life. So if that is something that you are thinking about, you want to sit down with your advisor and with Cure Alzheimer's to talk about it and to think about it. Next slide, please. So there are a couple more slides here about charitable remainder trust and charitable lead trust. I won't go into details about them because they're pretty technical. What you want to think about, I only want you to be aware that there's flexibility for tax purposes, for income tax purposes, that you could do rather than just outright gifts. Let's advance to the next slide. So we talked about it. CRTs, you get the income back. Go to the next slide, please. Charitable remainder trust. The charity gets the income first. It's typically used for very wealthy people to eventually go to grandchildren. Next slide, please. Gifts to real estate, many choices, outright. But you have to be careful of what Presley Blake did with his yacht, okay? You can't make a gift and get a charitable deduction once you signed a purchase and sale agreement. Like with the asphalt plant, we had to be really careful. With the violin, we had to be really careful. Before you go ahead and do any kind of charitable gifting where you don't want to pay the gain and you want to gift it to charity, the charity might sell it, or the CRT might sell it, or the charitable lead trust might sell it. You can't have any prearranged transaction or you will get denied the charitable deduction. But think about and explore choices beyond just cash or appreciated securities. Everybody should explore the remainder, the retirement planning asset. That's a fundamental one. Next slide, please. Planning is a process. And I think the question is, if not now, when? There's never a good time or right time to consider any of these issues. And everybody has a planning tolerance. So start now, get your healthcare proxies updated, think about your legacy, think about integrating your planning, think about what you really care about. Philanthropy is never and should never be one and done. It is your relationship with philanthropy, your relationship with Cure Alzheimer's and the organizations you care about will evolve as the organization evolves and you evolve. So think about it and be intentional about your planning, the legacy, and most important of all of this, commit to the process. Because if when you sit down every year and you look at your tax returns and you start to think about it and pay attention to it and keep this in mind, magic happens. So thank you very much. And Danny, I think now if there are questions, we can take them. I don't know if there are any in the chat.
Well, Patricia, thank you so much for such a wonderful presentation. Thank you for sharing your personal connection to our mission, as well as your professional expertise. We're so grateful. We do have a few questions that I'll get us started with. For our audience, please use the Q&A feature at the bottom of the screen and type your question, and we'll get to as many as we can in the time we have remaining. So, Patricia, let me start us off with, since we talked about the personal sort of aspect of estate planning, what advice do you have to people who maybe are thinking about creating an estate plan and how they might share that with their loved ones and with the people that might be impacted by the decisions they make? How do you approach that with folks, and what advice do you have?
Danny, that is such an important question, and it varies depending on the personality. Some people want to share it. The only problem with sharing it is if you change your mind later and take somebody out, people might get offended. I think what's important is that they know where the documents are. And if you're comfortable in an open, honest communication, people don't like surprises. The more that a family can know about it, the better off they are. But people get concerned. Is my son-in-law a gold digger? Is somebody looking at me for my money? Maybe they shouldn't give money to Cure Alzheimer's. Why are they doing that when it could be me? All of those kinds of issues. But Generally, it's better to educate. Education leads to empowerment, leads to action. The more that you are aware, I dealt with a family. He was worth close to $2 billion, died with the foundation, left each one of his kids 500,000, period. And you know what? No one was unhappy. You know why they weren't unhappy? They knew that their whole life. It is better to communicate openly than have surprises at the end.
Thank you. There's a question in the chat about how to donate one's home. And the question's around, is there an recommended age? But I wonder if you could maybe think about that as like a broader question. The idea of gifting a home either to charities or perhaps thinking about potential heirs. What considerations should people think about when they consider what to do with their home, which is often their greatest asset?
Yeah, first of all, don't gift your home to family members if at all possible, because for three reasons. From a tax point of view, you're probably paying more taxes than you need to, because if you're my son and I give you my $1 million house that I paid $100,000 for, then when you sell it, you have a $900,000 gain because it's not your primary residence. Okay. If I instead leave it to you in my will, you get that $1 million house and you don't pay any gain. Number one, tax mistake. Number two, much as I love you and you've been a good son, you could get divorced and then my asset isn't yours. Or you could have children applying to college, and once it's listed on the financial aid application, it takes them right out. So your home is your castle. For family members, I think it goes absolutely last. Don't go really, really carefully before you give your home away. For charity, you could do like the woman I did dealing with the hospital, a reservation of life estate, or you can, if I've got people who got 4 or 5 homes and they just don't need one anymore. Okay, so why not give it to a charity and let them sell it and deal with it and have that. The other thing is to do it through your will or your trust. I mean, you'll get a charitable deduction that way. But if you give it away now, then you also don't have the carrying costs anymore. So if you're no longer going to that musical performance in the western part of the state and you don't want to go through the hassle of selling it, and you don't need it, then maybe the charitable deduction is a really good idea for that asset.
Thank you. There's a question about if we're thinking of designating assets in our estate plan to a charity, is it better, or is there any consideration about giving a fixed amount versus a percent of the assets in my estate?
Danny, I get that question all the time, and it comes down to this. Do you care if people know what your net worth is? Because if you care what people know what your net worth is, then don't do a percentage. So some people will say to me, "Oh my God, I never thought about that. I don't want that." And other people will say, "I don't care, I'm dead." The problem with leaving a fixed percentage, if you don't stay on top of your planning and look at it every year, it could become a disproportionate, either too little or too significant part of the plan. So if you're going to commit to the process of reviewing it annually, do a fixed amount. If you care about what people are going to see your net worth to be, don't do a percentage.
So I suppose a related question about maybe people knowing then information. If I've elected to choose to make a gift to a charity as part of my estate plan, do I have any obligation to notify the charity, or do the successors of my estate and whoever manages the process, what obligations are there to communicate with and share with the organizations?
In my experience, the charity would love to know that there's something in the wings, right? But you, as the donor, are not obligated to go ahead and do that. So, it is something that you need to really think about. It's if you have a close relationship with the charity and you want them to understand that as part of the planning, it's a good idea to notify them. But you don't have to. I mean, the charities want to know that. Most charities, I don't know if Cure Alzheimer's has this, have a legacy society, where if you are including the organization in your planned giving, then you become a member of the society. That doesn't mean that you have to reveal what dollar amount is going to them, but they would know then if something happened to you to go ahead and look. Does Cure Alzheimer's have that?
We do, and it's certainly something that we're continuing to grow and continuing to expand that communication with our donors, inviting them to share that information with us.
And obviously, things like gift annuities or charitable remainder trusts, it's more important to have a conversation directly with the charity about those kinds of gifting vehicles.
Okay. So, in terms of the process, so we've elected to include a charity in our plan, and after a donor's passing, can you tell us a little bit more? We touched on probate during your presentation. What is the process, and maybe what's the timing, how these things normally go from someone's passing to then the realization of these different gifts and different aspects of their plan?
So a life insurance policy paid to a charity or a retirement plan paid to a charity, that's pretty quick. They submit those pass by contract. So that is a pretty quick fix, 2 months. If it's through your will or trust, most states in the country have what's known as a 1-year creditor statute of limitations, which means a fiduciary would be personally liable for satisfying a bequest to a family member or to a charity until that 1 year is done. And the reason for that is this knowledge that, creditors out there have the opportunity to be able to file a claim. And, if the creditor might not know immediately that somebody died. So the law gives creditors a time to surface. So any fiduciary who makes a payment to an individual or to an organization within 1 year of the death through a will or through a trust that was revocable and now irrevocable is personally liable if a creditor surfaces.
Okay, thank you. You've said this phrase a few times now, stick to the process. What do you recommend in terms of the age of somebody who might start putting all those, both the living documents you talked about and the future planning documents? And what do you recommend in terms of a cadence? I think you've mentioned annually. What can you tell us a little bit more about your recommendations as somebody who wants to then begin this process that you've described?
Danny, it is so odd, but as it's all changed, we're now living in a 7-generation world, right? We all know people who are 1, we all know people who are 100, and there is no more age at which you should do anything. It's all ages, right? It's all ages because who knows what your health is. Young people are getting really rich. Old people are getting really poor. It's all over the map. So once you hit the age of majority, 18 in most states, some 21, you should have a healthcare proxy and a durable power of attorney. Okay. And you might also think about doing a will. You should look at it at least every 5 years, or when there's a major change in family, economic circumstances, or tax law. But if you thinking about it when you are doing your tax returns, then at least you've got it in your head hooked to the financial component so you can be aware of it. But if there's a divorce, if there's a remarriage, if there's an illness, if there's, the only emergency I ever have is someone who's dying, not someone who's dead and not someone who's alive, right? The worst time to do planning is when you're really ill. That's horrible for you and everybody else around you. So I think the bigger challenge is, how do we not be Scarlett O'Hara? How do we go ahead and say, we've worked so hard our lives to get where we are now with our family. How intentional do we want to be about what we want to leave and how we're going to live our life now? What do you want to be known for? What do you want to be remembered for? What cause do you want to contribute to?
Hi, Patricia. Looks like we had maybe a little bit of a technical error with your video, but you might be back with us.
I'm here. Can you hear
Perfect.
me?
I can hear you fine. So if anyone has any questions as we're doing the final, please submit it in there and we will get to it. Otherwise, let me just say again, thank you, Patricia. Thank you for sharing your expertise, your personal story, as well as your professional knowledge with us. We're so grateful for your time and for the information you've shared with us on how people can create a lasting benefit for themselves, their families, and for causes like ours that they care so much about. To everyone who joined us, thank you for being a part of our event and for your continued support of Cure Alzheimer's Fund. As you know, our mission is to fund research aimed at the prevention, slowing and reversing of this disease. Today's conversation reminds us that each of us has the opportunity to make a meaningful impact through the ways we give, plan, and create a legacy that advances causes we care about. We're deeply grateful for each of you. To stay connected with us, please visit curals.org. And if there's no further questions, I'll just finish again with Patricia. Thank you for your time, and thank you for being with us today. And thank you, everyone, for joining us. We're so grateful.
Thank you.